All right. Hi, everyone. Welcome to today's webinar brought to you by IronFX. Today, we'll be covering breaking news and setups, and we're starting in a couple of minutes. All right. Okay. Once again, hi, everyone. Welcome to today's webinar series brought to you by IronFX. Today's topic is going to be breaking news and setups. But of course, before we start, do take note of the risk warning that comes with trading Forex and CFDs. The products on IronFX are traded on margin and carry a high level of risk, and it's possible to lose all your capital. Right? These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Also, take note of the disclaimer below here. Right, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. All right, so my name is Ketan Ramachandra. So this webinar series is brought to you in a special partnership between IronFX and Everest Fortune Group, where we've been the finalists for Best FX and Equity Research for 2019, 2020, and 2021. All right, so just a simple agenda for today. We'll look at some of the upcoming news events that could potentially act as a catalyst for currency markets, commodities, and perhaps even the indices as well. So coming up tonight, we've got unemployment claims in the US, followed by Federal Reserve Chairman Jerome Powell taking part in a panel discussion as well. And then tomorrow, we've got UK GDP data coming up, as well as inflation expectations. All right, so what are unemployment claims? Basically, unemployment claims is a data point, is a survey that tracks the number of American workers that are filing for unemployment benefits. So when you have a number that is trending lower, that means there are less people filing for unemployment benefit. That means the labor market is robust. If that trend reverses and we see more people filing for unemployment benefits, that means potentially we are starting to see some signs of cracks in the labor market. So for this week, or rather for this evening, we've got a forecast of 218,000 claims. As you can see on this chart here, over the last 2 weeks, the blue bars are the actual data or the actual result, and the orange bar is the estimate or the forecast for that particular week. So as you can see, over the last 2 weeks, not only have unemployment claims been trending higher, they've also been coming in higher than the forecast. So when you have unemployment claims in this scenario coming in higher than the forecast, this usually functions as a bearish catalyst for the US dollar. Right? This is because as unemployment claims rise and they come in stronger than the forecast, it means there are more people filing for unemployment benefits, and that means that potentially the labor market is starting to loosen or beginning to show signs of cracks. So that would mean that the economy may not be as strong as it is moving forward, and that is likely to negatively impact the value of the US dollar. So hence, if the dollar drops, you will see currency pairs such as the euro, the pound, the Aussie, and the Kiwi rise, and gold prices potentially rise as well. Now, as you see over the last 10 weeks or so, this trend was unemployment claims were firmly in a downtrend. Not only were they in a downtrend, but they were also coming in lower than the respective forecast. So during this period, this data point would have usually functioned as a bullish catalyst for the dollar index. So in this scenario, the value of the US dollar goes up, dollar index naturally goes higher. And we see currency pairs such as the euro, the pound, the Aussie, and Kiwi falling. And we also would see gold prices falling as well, typically during this period. So this is how we can interpret unemployment claims. So just to take note, the forecast later today is for 218,000. So just to repeat, If the actual result comes in greater or higher than 218,000, this will typically function as a bearish catalyst for the US dollar, right? And that would mean currency pairs such as the euro, the pound, the Aussie, Kiwi, and gold will rise. Similarly, if not similarly, conversely, if the actual result is lower than 218,000, this would typically function as a bullish catalyst for the US dollar. So that would mean currency pairs such as the euro, pound, Aussie, and Kiwi, and precious metal gold are expected to fall. Do take note, this is the expected reaction for each typical scenario, but it doesn't mean that it will always play out that way. So do take note, typically, if the result is higher than the forecast, this is bearish for the US dollar. But do take note, this is not always the case. There could be other factors at play, because especially if there are other economic data points coming up around that point in time. Similarly, if the result is less than 280,000, this typically acts as a bullish catalyst, right? Okay. Right, then moving on, we have tomorrow on 10th of November, we've got GDP data out of the UK. As you can see over the last, this is the monthly GDP indicator. So as you can see over the last 5 or 6 months, GDP data has been relatively choppy, right? You can see small monthly gains as well as declines as well. But for June, we saw a very sharp monthly gain of 0.7%. But in July, we had a sharp decline of negative 0.6%. And then in August, we have a growth of 0.2%. September's number is coming up at 0% as well. But because we saw in the previous monthly reading that output in several sectors has been falling. Output in consumers facing services, production output, as well as manufacturing are all declining, and including construction as well. So this doesn't point to a very robust GDP figure, and also you can see a lot of deterioration starting to seep in. Similarly, when you look at the UK's composite PMI readings, the last 3 readings have all come in under 50, so that signals a contraction for the manufacturing and services sectors. Right, so if we look at the latest report, which was for the month of October, you can see, right, as this is the 3rd consecutive month of reduction or contraction in this sector, with both manufacturing, production, and services continuing to contract. New orders, which is typically a signal, an indicator of future demand, also declined as well, and employment levels have dropped for the 2nd consecutive month. So as you can see, these are all very negative data with respect to economic growth. So even though we have an estimate of 0%, that means is the economy is not expected to grow on a monthly basis. Do not be surprised if we get actually a decline in economic activity for the month of September, right? Given the state of the UK composite PMI report and what we've seen, we could very well get a decline in economic activity for the month of September. So if we do get a monthly decline, this is very likely going to function as a bearish catalyst for the pound. So that means the currency pair such as pound dollar is likely to fall, right? But however, if we do get a surprise reading, which is quite unlikely, this may temporarily function as a bullish catalyst for the pound. So that means the currency pair pound dollar or cable is expected to rise, right? So this is how we can what's something to look out for tomorrow with regards to UK's GDP data, right? We also have inflation expectations coming up in the US. So this segment is from the University of Michigan's Consumer Sentiment Report or Survey. So we have the preliminary data for November coming up tomorrow. And as you can see, inflation expectations accelerated for the month of October, right? So we had inflation expectations at 3.2% in September, and October's reading showed an acceleration to 4.2%. Now, should the preliminary result for November indicate this trend growing higher, then this quite likely could function as a bullish catalyst for the US dollar, right? So with inflation expectations starting to rise, this would signal that the Federal Reserve needs to maintain rates at a higher rate. They may not continue to increase rates at the next meeting, but they will definitely signal a higher for longer approach to monetary policy. So do take note how inflation expectations out of from the University of Michigan's Consumer Sentiment Report could potentially act as a bullish catalyst for the dollar index. Right. All right. Hi, Damir. Good to have joined you. All right. So just in case you have missed out, right. Okay. So do take note. Right. Okay. So welcome to today's webinar series, which is breaking news and setups. Do take note of the risk warning and disclaimer as well. Right, so my name is Ketan Ramachandra. So this webinar series is brought to you in a special partnership between Everest Fortune Group and IronFX, where Everest Fortune Group, we've been the best finalist for best FX and equity research for the following years. Right, so simple agenda for today before we look at the charts, some of the key economic data points that could move markets later on today as well as tomorrow. So up tonight or coming up in a couple of hours, we've got unemployment claims in the US, and we also have Federal Reserve Chairman Jerome Powell speaking at a panel discussion as well. Right. So with regards to unemployment claims, over the last 2 weeks, we've seen this figure come in higher. So unemployment claims basically is a data point or a survey that tracks the number of US workers or who have now starting to apply for unemployment benefits. So if you see a trend that is coming in low, that is falling, and which is also coming in lower than the forecast, do take note that the blue bars are the actual data or the actual result, and the orange bars are the forecast. So if the data is the result is coming in lower than the respective forecast and the trend is also lower, this usually signals a robust labor market because you have less people filing for unemployment benefits every week. Right, so this would then typically would function as a bullish catalyst for the dollar index, and that means currency pairs such as the euro and the pound will fall, Aussie Kiwi will fall as well, and gold prices too. But what we are seeing now over the last 2 weeks, that the trend has somewhat reversed and looks like it is starting to trend higher. Not only is it trending higher, the data is also coming in higher than the respective forecast. So now this would now function as a bearish catalyst for the US dollar. Similarly, we have the forecast of 218,000. So how can we interpret the data? So basically, if the result is greater than 218,000, this would typically function as a bearish catalyst for the US dollar, right? So that means if you have more people filing for unemployment claims or unemployment benefits, this would signal that the labor market in the US is starting to show some signs of cracks. And that means moving forward, the economy may not be as strong as it currently is. So that means the value of the US dollar is likely to depreciate or fall. And that means currency pairs such as the euro, pound, Aussie Kiwi, and gold as well will rise. Conversely, if the data is lower than 218,000, this would typically function as a bullish catalyst for the US dollar, as this signals a robust labor market. So that means currency pairs such as euro, pound, Aussie Kiwi, and gold as well will typically fall, right? So this is how we can easily interpret the data for later today. Right, okay, UK GDP has not been great. It's been a bit patchy, and with the latest estimate for September pointing to a stall in economic activity. We may even see economic activity contract on a monthly basis. Why is that the case? Because we can see UK composite PMI data contracting over the last 3 months, right? We also see a reduction in both manufacturing and the services sector. New orders, which is an indicator of future demand, have also started to decline, and employment levels have dropped as well. So it's all very very negative news with respect to economic activity or economic growth. So do not be surprised if the monthly reading for September actually shows a contraction in economic activity. Right now, if we get a number that's lower than the forecast of 0%, this is very likely going to function as a bearish catalyst for the pound. So that means the currency pair dollar pound or cable is likely to fall. Right. Okay. Then just looking at US inflation expectations. Now, this inflation expectations data is from the University of Michigan's Consumer Sentiment Survey. So in October, we saw this inflation expectations metric accelerate from 3.2% to 4.2%, a very sharp increase. Now, tomorrow, the preliminary findings of this survey will be released, which should show November's data for inflation expectations. Now, if we get another reading that's higher than 4.2% or that shows inflation expectations accelerating once more, then it is quite likely this could potentially function as a bullish catalyst for the dollar index. Similarly, if the preliminary result for November shows inflation expectations moderating, perhaps coming in at 4% or even lower, now then this could then function as a bearish catalyst for the US dollar. All right, this is how we can interpret the data for US inflation expectations, as well as UK monthly GDP and unemployment claims. Right. With that, let's move on over to Forex Factory. Right. So currently I'm on GMT time. Right. I'm on GMT time. And we can see, all right, okay, hang on. And we've got Federal Reserve Chairman speaking at 7 p.m. GMT time today. We've also got unemployment claims coming up at 1:30 p.m. today. So do take note of that. And for tomorrow, we've got the preliminary results from the University of Michigan's Consumer Sentiment Survey up at 3 p.m. GMT time. So do take note of these economic news releases that could potentially drive the direction for the US dollar. And of course, then that would impact currency pairs as well as the price of gold. All right, now let's dive straight into the charts. Okay, so I'm currently on the 4-hour time frame for the dollar index. So these are some of the levels that we had identified earlier today with regards to support and resistances. All right, so price is currently trading about 105.60. We can see there's not been much movement for today after price dollar index hit a high of 105.86 yesterday. It's been pulling back quite sharply, and you can say it's been consolidating around 105.50, 105.60 for most parts of today so far. Right, so if we do get a bullish catalyst for the dollar index, that means we see unemployment claims coming in lower than the forecast of 280,000. And we also see Federal Reserve Chairman coming in with a very hawkish outlook with regards to monetary policy. Both of these data points would then function as a bullish catalyst for the dollar index. So that means we are very likely to see dollar index break above 105.72, which is an intermediate resistance, right? I labeled this as an intermediate resistance because we can see here since Tuesday, price has not been able to break above this level convincingly. But if we do get a bullish catalyst, then it's quite likely this level is going to be taken out. And where the dollar index could eventually find major resistance would be at the first resistance, right? The first resistance is at 105.95. This is a strong pullback level here, because we can see price making a significant swing bounce here on 31st October, as well as finding support once more on 2nd November, right? And not only that, we also have the Fibonacci retracement at 50% acting as a contributing factor to the significance of this level, right? So if we do get a bullish catalyst for the dollar index in the next couple of hours or for the rest of the day, then very likely we're going to see dollar index take out 105.73, and where we could potentially target a take profit zone would be around 105.95. So do take note, around the 50% Fibonacci retracement would be a good area to take to book your profits should we see the dollar index rise higher. Now conversely, if we get unemployment claims coming in higher than the forecast, right? If it comes in higher than the forecast, this is going to function as a bearish catalyst for the dollar index. So that means we would see dollar index fall. And also, if we get in that situation, if we also get Federal Reserve Chairman coming up with a relatively neutral outlook or neutral comments and statements, then very likely both of these factors would then function as a bearish catalyst for the dollar index. And it's very likely it's going to drop towards 105.35 around that level. Now, this is a key support level because You can see price finding decent support here on 21st of September before bouncing higher. And it found very strong support, making a very significant swing low here on 24th of October before bouncing higher once more. So you can see two instances where price has bounced off this level very significantly, and that is why we have used it to identify it as our first support, which is the pullback support at 105.35. So if we do get bearish catalyst for the dollar index, do take note, it's quite likely it could find support around 105.35. And of course, the second support is at 104.81, which is once again a very strong, significant, you could argue here as is a double bottom here, making a pullback support here before bouncing higher. Then as recently as Monday, price bouncing off this level again. So you can see two significant swing bounces here or swing lows here that indicate that 104.82 is a very significant level, which is why we've identified it as a second support, which is a pullback support level. All right, let's just tidy up the chart so everything is clear. Right, okay, so do take note of the levels for the dollar index. This is, I'm on the 4-hour time frame, and how the potential data later this evening or early this morning, depending on your time zone, would impact the direction of the dollar index. Right, okay, with that, moving on to the euro. Right, okay, so these are the levels for the euro. So similarly, with the dollar index starting to rise up today during the European session, naturally currency pairs such as the euro and pound dollar will be falling. Right, so where the pound could find support, if it would be around 1.0664, we do see a case for a pretty decent overlap level here. We can see price running into resistance here on 2nd November, price running into resistance here as well on 31st of October. And then when price broke above it, it found support not once but twice on 7th November as well as on 8th of November. So you can see how price has reacted off this level multiple times, which is why we've identified it as a significant overlap level that's being used as the first support. Right, we've also drawn a Fibonacci retracement. This retracement started from this swing low here on 2nd of November, going up to the swing high here on 6th of November. We can see that the 38.2% and 61.8% Fibonacci retracement levels align very well with the first support and second support. The first support is a significant overlap level that also has the additional supporting factor of the 38.2% Fibonacci retracement. Second support at 1.0615 is a pullback support level, right, with price falling sharply on 2nd November and then before finding support and then bouncing higher, is a pullback support level that aligns quite close to the 61.8% Fibonacci retracement. All right, so do take note of the support levels here. Similarly, if we do get a very bullish catalyst for the dollar index, then of course we're going to see the euro continue to fall and perhaps even break under 1.0664. So do take note of that. Now to the upside, we've got the first resistance at 1.0559. How do we identify this? You can see price running into resistance here on 12th of September, then once more on 13th of September before going lower. Right, so this is a pretty significant pullback support area, and you can see once again price running coming very close to this level at the start of the week before running into resistance and dropping lower. So you can see multiple instances where the euro has run into resistance around this level and proceeded to retreat from it. So this is how we've identified the first resistance level at 1.0759, which is a pullback resistance level. Right, similarly, for the second resistance at 1.0835, let's zoom in a little bit here. Right, we can see after price made this significant swing high here on 31st August, it fell very sharply, but then it found support around this level on 1st of September, right, before retracing a little bit higher and then finally breaking through. So this level functioned as a pretty decent pullback support level in the past, which is now why it could potentially function as pullback resistance should price break above the first resistance, right? Not only that, I think I would also like to highlight a zone for the first resistance rather than an absolute level, right? Because if we looking at the shaded box, you can see here price finding support around 1.0775 on 25th of August, and then finding support once more on 2nd of September as well. Right, so you can see price has bounced off this level in the past, acting as a pullback support. Now this would potentially function as a pullback resistance. So we got a range, a resistance range from 1.0759 all the way up to 1.0775 for the first resistance zone. Right, so do take note of these levels for the euro. Right, let's see if we zoom out a little bit. You can see since mid-July, the euro has been in a very strong downtrend, right? I think there may be a Fibonacci level here. Let's see. Let's start from this swing high here on 18th of July, going down to the swing low on 3rd of October. All right, let's just pull up all the fibs so that we can get a good idea of where everything is. Right, yeah, we do see the 38 and 50. Let's just keep those two levels. Right. Okay, so we do see the 38% line up very well with the pullback resistance that we had identified. And if I were to argue, if I were to stretch this level back all the way to this swing low here on 25th August, this is actually an overlap level, right? If I were to pull this level all the way back, we can see that this is actually a significant overlap level for the euro. So this is a major resistance level, right? So we would need something pretty tremendous. We need a tremendous move for price to break above this level. Now, that could be a major economic data point, or could be a very strong order flow as well. All right, so do take note. First resistance at 1.0759 is indeed a very significant overlap resistance zone, and second resistance is at 1.0835. All right, so these are the key levels for the euro on the 4-hour time frame for today. All right, okay, let's move on to the pound. Since we've got UK GDP data coming up tomorrow, right? So let's see where some of the levels for the pound currently reside. Right. Okay. So of course, no surprises to where the first resistance is going to be. It's simply going to be the swing high that took place on Monday, which is at 1.2424. We also do see the case for a decent overlap level at 1.2535, pretty significant level. Why is that the case? Because we see as price retreated sharply on early September, it found support at this level briefly on 5th September before finally breaking lower. And after that, it failed to break above this level, running into resistance on 11th September before proceeding to drop lower. So you can see this is a pretty significant overlap level, which is why we've identified it as the second resistance. Right. Similarly, if we were to draw the Fibonacci retracement, here I believe we should see some retracement levels that line up quite well with the resistances that we may have identified. Let's see. So we'll start the swing high here on 14th of July, going down to the swing low here on 4th of October. Let's see. Okay, I don't think we've got any Fibonacci. All right. Okay, we do not see any of the Fibonacci levels align very well with the resistances. What we try not to do is try to force a resistance level onto a Fibonacci retracement, right? Never force a significant swing high resistance or a significant overlap with the Fibonacci, right? If the Fibonacci does happen to align very well with the overlap or swing high resistance that we had identified earlier, that's great. But never force a resistance level onto a Fibonacci, right? If it's not there, it doesn't align, that means it's not there. So that's why for the pound, we're not going to use the Fibonacci on this move, on this leg here. But you can see how for the euro, oops, hang on. But you can see how for the euro, when we applied the Fibonacci retracement, we did find decent levels, right? We did see, right? We did see the 38 and 50, the 38 aligned very well with the first resistance. 50, not so much. So actually, technically, we shouldn't be using the 50 as well, just 38. Right? Okay. So never force resistance or support level onto a Fibonacci retracements, right? They are there to add as a supporting argument or supporting factor to the significance of that level, but never force a level onto the Fibonacci retracement, right? Do take note of that. All right, so back to the pound. So we know where the major resistance levels are, right? So let's just focus in on this part of the chart, right? Okay, after price made this swing low bounce here yesterday, right? Price made a pretty Since Monday, price has been trending down lower quite sharply before finding support here, making a pretty significant, or making a pretty decent retracement higher. So I've identified this level at 1.2242 as an intermediate support. It's not the strongest level here that I think in terms of support, but because we do see a pretty decent bounce off this level, I've identified it as an intermediate support level. And the first major support for the pound is at 1.2215, which is this pullback support level here that aligns quite well with the 61.8% Fibonacci retracement as well. And we see the retracement lining up pretty well with the pullback level. And we see the second support at 1.2169, which is an overlap level, right? Price running into resistance around here on 31st of October before finding support on 2nd November. And it's also a level that aligns well with the 78.6% Fibonacci retracement, right? So these are the key levels for the pound. So similarly, if we do get a bullish catalyst for the dollar, it's very likely we're going to see pound fall. And this intermediate support may not offer much support. And it could easily break through 1.2242, and where it could find some serious support would be 1.2215. So if we do get a bullish catalyst for the US dollar, so that means pound dollar is going to fall. And then if we do take a short position for this currency pair, do take note the area around the 61.8% Fibonacci retracement level would be an area where I would identify my take profit level, right? So this would be, if you just take it, let's just say, okay, we decide to short the pound at around 1.2270. Let's just say arbitrary number of 1.2270. So if you have shorting the pound from this level and it continues to drop lower, I would target the level of 1.2215, 1.2220 as my take profit zone for the pound. All right, so do take note of that. All right, okay, with that, let's look at. Right, okay, Damir, if you got any requests for any analysis that you would like to see, do not hesitate to drop your request in early, right, so that we have time to go through it properly, right? Otherwise, I will just go through some of the majors, then we'll look at oil and gold as well. But if you have any requests for any of the crosses or indices or anything else that you would like me to go through with you, do let me know early so we have time to go through it properly. All right, okay. So let's see. Okay, let's look at dollar yen. Right. So dollar yen. Okay, so let's just zoom in here. All right, before we zoom into dollar yen, as you can see, yen is approaching a very significant resistance level. And if we look on the monthly chart, right, 152 was a level last seen in May of 1990. So these are actually 30-year highs for the dollar yen. You can see this a very significant level, very high level, 30-year highs for the dollar yen. And what happened last year in October was because the yen was getting devalued significantly. So do take note, when dollar yen rises as strongly as this, it means the Japanese yen is getting devalued very significantly. That's not great for the Japanese economy. So in this scenario, the Bank of Japan actually intervened in the open market. So they carried out intervention operation whereby they were selling US dollars and selling US treasuries and using the sales proceed to buy up the Japanese yen in the open market. So when they do that, that causes dollar yen to fall significantly, which is what we see here, right? As you can see here, this is when the intervention operation commenced towards the end of October, early November, and they continued to intervene in the open currency market all the way till the end of January. So when they intervene in the open market, they are actually selling US dollars, selling US treasuries, and using the sales proceeds to buy up Japanese yen, which then causes the dollar yen to fall very sharply, right? Naturally, the other yen crosses would have pulled back during this period, but not as much as the dollar yen. And when that intervention operation ended towards the end of January, that's when market forces resumed. And then you can see the monetary policy divergence between the Federal Reserve and Bank of Japan take place. Do take note, Bank of Japan is still the only major central bank in the world to have kept this policy rate as negative 0.1%. It did not raise interest rates at all over the last 22 months or so, or the last 2 years. whereas the Federal Reserve has been aggressively raising interest rates. So when the intervention operation stopped, that's when you can see market forces resume, and of course that means dollar yen is going to rise. So now that brings us back to 151, 152, which is quite likely. We may see there is talks of, or rather there is rumors of the Bank of Japan intervening in the open currency market once more. So do take note of that. All right, so we are approaching very significant levels, and just today we had identified, earlier today we had identified 151 as an intermediate support, because price, intermediate resistance level, because price retreated from this level yesterday, and we were looking for a potential bullish breakout. So this breakout level has triggered, and we are looking for dollar yen to potentially rise up to at least about maybe 150, 140. I'm not sure if you'll reach the first resistance at 150, 170, but at least it should reach 150, 140, 150, 150, right? So this is a pretty good bullish breakout to take note, to have gotten in, but not at this price. Probably, okay, you are just about 10 pips off the break entry. Yeah, I guess. Okay, you could still pretty much enter around this level, but I would keep a relatively tight stop loss. So I would use the bottom of this candle, the lowest wick of this candle, which is maybe on 151, and I'll probably set a 20 pip stop loss away from this level. So I'll probably place my stop loss at 150, 80, and then potentially try and capture 150, 150. So at least you would get about 1 to 2.5 risk reward ratio, right? And of course, we have the intermediate support for dollar yen at 150.58, right? How do we identify that? That we can see price running into a little bit of resistance here in early November, and then running into resistance as well on 7 November. And this level aligns quite well with the 23.6% Fibonacci retracement as well. So that's why I've identified it as a pullback support level. The first major support for dollar yen, of course, would be the significant swing low here. You can see price making a very significant swing low bounce here on 3rd of November. So that's where we've identified the first major support for dollar yen. All right, so do take note of these levels. All right, okay. Moving on, let's look at Aussie and Kiwi. Right, okay. So we can see today this level at 64.16, we identified it as an intermediate resistance. Why is that the case? We see price bouncing off this level on 3rd of November as well as 7 November. So previously this functioned as a pullback support level, but once price ran, broke underneath it, you can see at various points on Thursday, price attempted to break, or well, today it attempted to break above this level, but failed to do so. That's why we identified it as an intermediate resistance. First major resistance is at this pullback level here at 64.55, which also aligns quite close to where the 50% Fibonacci retracement is. And of course, we see a very strong support level for the Aussie. It's a very significant overlap at 63.92. Why is that the case? We see price bouncing off this level on 10th of October as well as of 11th of October, right? Two strong bounces here. And then once price broke underneath it, you can see two significant swing high resistances on 18th of October, as well as this second swing high resistance on 25th of October. So you can see multiple times where price has bounced off or reacted off this overlap, which signifies a very significant level, and it also aligns very well with the 61.8% Fibonacci retracement. So do take note where the Aussie could potentially find strong support would be this level, right? 63.92. So if you have been shorting the Aussie since earlier today, so perhaps from maybe about from 64.10, about 64.05, do take note at about 63.90 potentially is where you should perhaps consider booking some profits. But if we do get a very strong bullish catalyst for the US dollar, that means Aussie dollar could very likely break below this level, right? So do take note of how the of how a potential bullish catalyst such as the unemployment claims data could potentially push the pound, the Aussie lower. All right, okay, second support is simply this swing low here that took place on 1st of November. We can see price falling quite sharply at the end of October, and then finding support in early November before bouncing higher. So that's how we've identified the second support. All right, okay. Otherwise, okay, let's move on to the Kiwi. Similarly, you can see that the price action between the Kiwi and the Aussie is very similar. Market structure is very similar. So if, generally speaking, if we do see the Aussie in a downtrend since the start of the week, the Kiwi is very likely to follow suit. So there's a strong positive correlation between the Kiwi and the Aussie. Right. Okay. So previously, earlier today, or was this yesterday? Yeah, earlier today, this morning, we had identified 59.17 as an intermediate resistance level. Why is that the case? Price ran into resistance here on 2nd November before briefly finding support on 7th November. And earlier this morning, price was trading underneath this level, which is why I had identified it as an intermediate resistance level. So if price were to break above this level, it could potentially go higher and perhaps till this level here at about 59.42. Right. So do take note of where, but now this level, this intermediate resistance is now going to function as an intermediate support. And I would then actually identify the top of this wick here as an intermediate resistance. Right, so do take note, 59.42 is an intermediate resistance level for the Kiwi, and the first major resistance level actually comes in at 60 cents. You can see price making a very significant swing high here back on at the start of the week. Similarly, when we look at these two swing highs here on 29th of September as well as on 11th of October, these are multi-swing highs. So this is a very significant resistance level as well, or very significant resistance level. That's why we've identified it as a second resistance at 60.48. Right, and if we zoom out a little bit, yes, you can see similarly to the Aussie, where the Aussie's first support is, the first support for the Kiwi is a very significant overlap level. Right, we see price bouncing off this level multiple times before going higher. Similarly, we see price making a very significant swing low bounce here as well on 4th of October, and we can argue here as well, 17th October, price finding support just above this level before retracing a little bit higher. And once it broke underneath it, of course, we can see price running through resistance a few times, 20th of October, 24th of October, and as well as 25th of October. So you can see multiple instances where price has reacted significantly of this level, or has reacted strongly of this level, which tells us that 58.66 is indeed a very significant overlap level. And it just so happens that the 61.8% Fibonacci retracement aligns very well with this level as well. So that's why we've identified it as the first support. Second support is this swing low that took place on 1st November as well. All right, very similar market structure and support levels with regards to the Aussie and the Kiwi. All right, okay, let's look at oil, and then we'll look at gold as well. All right, okay, so do take note, if you have any requests for any of the major currency pairs or commodities or even the indices, do let me know early so we can go through the analysis together and we don't have to rush through it as well. All right. Okay, then let's move on to oil. Oil has been in a very strong bearish downtrend since 20th of October, right after making this high at $93.70 per barrel, right? WT oil retraced very sharply, but it did get a second win. But since then, it's still been entrenched in a very significant downturn. All right, Zaid. Okay, I will definitely cover gold as well. We'll cover gold after oil. All right, now we'll cover commodities now, and then of course from oil we'll move on to gold. All right. So of course, as price retraces very strongly down, as price falls very sharply downwards, there's bound to be retracements up as well. We see pretty decent retracements here on 1st November, 3rd November as well. So we could see WTI oil price retrace higher today and tomorrow as well as traders close out the week, right? So as you can see on a weekly basis, let's look at the chart on a weekly basis. You can see we've had, including this week, we have three very strong declines. Let me say that again. We've had very strong declines on a weekly basis for 3 weeks in a row. Right, we had very significant declines for WTI oil for the past 3 weeks, including this week. So we may see a lot of short traders trying to potentially exit their positions now. So when we have traders who have been short on oil and are closing out their position, it can create strong retracements or reversals in price action, because this is caused by short covering, right? So as short traders close out their short positions, they have to buy back the positions, so that can cause the price of that commodity or that instrument to retrace higher, which is quite likely what we could see for today as well as tomorrow. All right. All right, thanks Wayne for your comment. Okay, Wayne, with regards to Elliott Wave, I'm not that uh it is indeed a very good technical analysis tool to use, but it's not something that I use regularly. So unfortunately, I cannot give you any insights on how to use Elliott Wave properly. But if you do study it and use it, I have seen traders who have a good grasp on Elliott Wave theory and have implemented it well on their in their analysis. So I believe yes, it is a very useful tool or analysis tool to use should you be able to grasp it. All right. Yeah, do try and look out for any Elliott Wave webinars by IronFX. I believe if you go head on to their YouTube page, there may be past webinars that could have covered Elliott Wave theory as well. So do head on over to IronFX YouTube page and look for the past videos where they may have covered Elliott Wave theory. All right. It is indeed a good tool to learn if you have the time, and it's definitely quite useful in technical analysis as well. All right. So back to oil. Oil is very likely to retrace higher. Where it could run into resistance is this pullback level here. If you zoom out a little bit, you can see price running into resistance on 14 July as well as on 19 July. And this level aligns quite well with the 23.6% Fibonacci retracement. So if you have bought the bounce in gold here today, right, it's quite likely we may see it push higher, at least towards $76.90. So around that region is where you could potentially start to book some profits for WTI oil, right? Okay, so for the intermediate support for oil is simply this pullback support level here that's taken place since yesterday, right? So it's an intermediate support because it's not a very strong or significant support level. Where we see significant support is at $73.95. Why is that the case? We see a very significant swing bounce here, right? We see price for hang on. We see price falling quite sharply here on mid-July before bouncing higher, right? So that is why this is a very significant price action here, and it offered strong support, and that's why we've identified it as the first support, which is a pullback support or swing low support at 73.95, right? Okay, second resistance for oil, for WTI oil in particular, is at $78.12. Why is that the case? Similarly, we see price making a very significant swing bounce here back on 24th of October. And this level aligns very well with the 38.2% Fibonacci retracement as well. All right, welcome, Wayne. All right, so do take note of the first, second resistance levels, and do take note that because we've had such heavy selling over the last 3 weeks, we are very likely to see traders starting to exit their short positions, and that could lead to a short covering phenomena, which could see WTI oil rise up at least towards $77 per barrel, where it could find once more run into resistance. All right, with that, let's move on to gold. Right, we can see right now gold is testing a very significant support, which is at $1,947 per ounce. We see price running the resistance at this level here from 31st August all the way till 4th September before dropping lower, then running into resistance once more on 21st September. Right, you can see 1,947 is indeed a very strong level or very significant level, because this up to this point here, this level functioned as a pullback resistance level, a very strong pullback resistance level. But when it finally got broken, it then proceeded to function as a support level as well, right? So now this pullback resistance level then turned into a overlap support level, right? Because we can see price then finding support level here. So you have two resistance here, one support bounce here. So this level now functions as a significant overlap level. That is why I've identified it as the first support. So you can see price has indeed found support around this level and is finding it quite difficult to break below it. You can see since early this morning, price has tried to break beneath this level, but it's not been in a convincing manner so far. So that's why first support at 1,947 is significant. Right, 19,032 is a pullback resistance level, right? You can see price running into resistance here on 14th of October and then again on 17th of October. Right, so this level was a significant pullback resistance level, which is now going to function as the pullback support. That also aligns very well with the 38.2% Fibonacci retracement. So if you look at this retracement, right, we started this retracement from this swing low here on 6th of October, ending with the swing high here on 28th of October. You can see the 38.2% lined up very well with this pullback resistance. Now, where could be, let's say, let's just imagine if gold breaks first support and second support, where would the next support level be? Okay, so let's just pull up all the fibs, because before that, I can already see a pretty decent pullback support level around here as well, right? We do see a pretty decent case for a pullback support level around here, which is 1,913, right? You can see price finding support on this around this level on 21st September and then again on 16th September. And this level also aligns quite well with the 50% Fibonacci retracement. So this would be the next support zone for gold prices. Right. So with that, let's just keep 38 and 50% Fibonacci retracement. We'll get rid of the others. All right. Okay. Now to the upside. Okay, let's just zoom in a little bit. Now to the upside, the first resistance. Okay, let me just tidy this part up. Right. Okay. And let me just get rid of all this so it's a little bit neater. All right. Okay. Right. Okay. So we look at where the first resistance is at basically 1,960. Right. Similarly, you see price running into resistance at this level on 18 October. Then after it broke higher, it found decent support on 24th of October before bouncing higher. And then again, finding decent support again on 7th November. So you can see multiple times where prices reacted on this level, which is why we have identified it as the first resistance. So this is a significant overlap level at 1,959.83, or pretty much 1,960. Similarly, for the second resistance, this is also a pretty significant overlap level, right? We see price bouncing off this level here on 26th of October, then bouncing off it again on 2nd November. And once it broke underneath, it found resistance on 8th November. So that is why 1,972 is a significant overlap level. And we've used it to identify this, as our second resistance. All right, so do take note. All right, so for those who may have, okay, Wayne, I believe you may have missed the earlier parts. I'll just quickly go back to unemployment claims, because we've got that coming up. So do take note, these are some of the key economic events for today and tomorrow. We've got unemployment claims on 9th of November. We've also got Federal Reserve Chairman Jerome Powell speaking. And we've got UK data as well tomorrow. So just quickly for today, before we wrap up, do take note, the forecast for unemployment claims for tonight or this morning, depending on your time zone, is about 280,000. As you can see, over the last 2 weeks, unemployment claims, not only have unemployment claims started to trend higher, they've actually come in higher than the forecast. Do take note, the blue bars are the results, the orange bars are the forecast for that particular week. So not only have claims started to rise, they've also come in stronger than their forecast. So when this happens, this usually signals, this means that that means that more people filing for unemployment benefits. Now that means that potentially we are starting to see the labor market in the US starting to loosen, or starting to be not as resilient as it has been in the past. So this would typically then function as a bearish catalyst for the US dollar, because if the labor market starts to loosen, we see more people filing for unemployment benefits, we start to see the unemployment rate increase. It is very likely, of course, companies are starting to cut jobs in a bid to cut on costs. So that means profits and margins are not great. So that means the economy as well could be starting to pull back as well. So that means that all these factors would point to or would function as a bearish catalyst for the US dollar. So that is why if any result that comes in greater than 218,000 is very likely going to function as a bearish catalyst for the US dollar. So that means currency pairs such as Euro, Pound, Aussie, and Kiwi, as well as gold will rise, right? Similarly, if the result comes in lower than 280,000, that means there are less people filing for unemployment benefits. This is very likely going to function as a bullish catalyst because that means the labor market is still robust. So the US dollar should go up, economy is strong. So that means currency pairs such as Euro, Pound, Aussie, and Kiwi, and of course, gold should fall as well. All right, so do take note of the data coming up today. And also, Chairman Jerome Powell, if his remarks and speech are hawkish as well, that means this could function as another bullish catalyst for the US dollar. All right. And also we have UK GDP data coming up tomorrow as well. All right. Okay. If there's nothing else, if we do have time for one last request, so if you do have any request for any analysis on the pairs, do let me know now. Otherwise, I'm just going to launch a poll, and I'll truly appreciate if you guys can give your feedback as well, because we're always looking to improve our webinar series and education and live analysis for all you guys, right? All right, if there's no further questions, thank you for taking part in the poll, and do look out for upcoming webinars by IronFX as well. And what's I gonna say? And I got YouTube, IronFX. Let me see if you can get the link. Hang on, just trying to get this for you guys. Hang on. All right, okay, so if you go on over to INFX, where's their YouTube page? Why is it not loading? Okay, just give me a sec. Sorry, guys. Right, so if you go to their videos, right, okay, so you can look at all the past videos as well. So if you go yeah, so any topic that you guys are looking for, it could be here as well, like how to trade gold, live trading session as well, build your trading strategy, swing trading as well, and any other education or live trading sessions you wish to tune into, it's all available up here as well. All right, okay, take care everyone, thanks for tuning in today, and wish you all the best in your trading journey. All right, have a great trading week, and I'll catch you guys next week. Take care. Thanks, you too, Wayne. Have a great weekend.